Hey, everybody. This is the Ask Me Anything show where you get to answer whatever questions you've got: money, finances, real estate. Let's see, you guys can put in a comment below and we'll see if we can try out this new format we're trying. All right, looks like we're having some people join. Hello. So, for some of you guys, I'll be seeing you in San Francisco in a couple of days, and I will be in Hey Patricia, and in a few more days, I'll be in Houston, checking out some deals there. So this is a point. If anybody's got any questions, please type it into the chat, and it should feed through to me live. So we got at least a dozen people on now. Any deals open? Well, you're gonna have to come to the website for that one. Hey, Evelyn. What questions do you guys have? Let's get a conversation going. Unfortunately, the way this thing works is I can't see who's typing the question, but I'm gonna kind of guess you this. Softball question: favorite wine? I like cabs. Depends if it's hot. If it's kind of a warm day, I like the whites, but most times I like the reds. But all right, here we go. So first question that's coming in: why do rich people bother running a business or investing in real estate when they can live off passively in index fund slash stock market? So I think the reason why I'm not a big fan of index funds or stock market and why I personally don't invest in that stuff is that it's retail investments. Retail investments just don't have as high returns. And the reason why is because the financial world, Wall Street kind of works off this concept of like the large institutions take off all the profits off the top. So unfortunately, as the retail investor, you're the one kind of left with paltry returns at the end. So by investing in real estate on your own or more directly aligned with the sponsor or the operator, you're able to kind of cut out the middleman, make a higher return. And so getting back to the question, why do the rich people bother doing this stuff when they can just do an index fund? Well, I think rich people depends what you define as rich, right? Like if you have under a couple million, few $1 million net worth, I don't think you can go to the retail type of marketable securities and get the returns you're looking for to grow your net worth to over a few $1 million. I think you're going to have to do it on your own or go into a syndication or private placement where there's value add to go find those returns to get up to that scale. Next question. Oh, hey. All right, next question. Current world news, any effect for real estate? So I've actually been watching this a lot, the Ukraine invasion by Russia. kind of a sad thing in my opinion. Definitely seems like some of the people in Russia maybe don't like it, but I'm gonna stay out of that politics aside. So one thing that's happening in the United States recently is, they said that they were going to pump up interest rates a little bit, and my first inclination was, and I started to see some headlines that I posted on the Facebook page that the interest rates weren't going to be well, the rate hikes were going to be kind of halted with this current war that's in there at this point. So I I kind of saw it as a point for, that's a good thing for investors, right? That interest rates aren't going to be going up. But then again, you look today and the Dow went up 800 points because, but then there's a freaking war going on. And this is why I don't like the stock market. It's like goes against all logic. I mean, there's a freaking war going on halfway across the country, yet you see that the stock market is doing good today, and therefore maybe that the interest rates are going to keep going up because the Fed realizes is that, if the stock market does well, then that there's more room for them to go and get more bump the interest rate, which is effectively dry powder for them to lower interest rates when the economy kind of falls on tougher times. So that's what I see is going on with this. But either way, it's just going to be very slow. I mean, the Fed said they were going to increase interest rates prior to the pandemic, and it took them like 5, 6 years to get even like a point or two up. I just don't see it being that drastic. And I don't think it really matters if you're in value add real estate because you kind of transcend interest rates and how that impacting you. Now, if you're a regular real estate investor investing in the buy and pray method, where you're just buying something and hoping that the price goes up, and you're not doing any value add or sweat equity onto it, then yeah, interest rates are going to be very impactful to what you're doing. But if you're in the value add game, it really doesn't matter. So, your next question, I'm hearing that the SEC is revisiting the investor definition. Any thoughts? Well, if you're an accredited investor, you probably don't care. But for some non-accredited investors, they're always adding ways. It always seems to go in the direction that there's always ways to get through to being an accredited investor if you're not an accredited investor by different series. I don't know what the series tests are, Series 7. Basically, for you to be kind of like a person who can sell marketable securities. A lot of these tests aren't the hardest things to get. But I think what people fail to realize is most deals out there are 506B offerings where you don't really need to be an accredited investor. You just have to be in the network of people. But I think the why the people fixate on accredited investor status is because a lot of the stuff you see on the internet, right? The crowdfunding websites, which are mass marketing, generally soliciting these deals, they're needing to have that accredited investor designation for people to be qualified to invest. But it's just something. I mean, when you're an accredited investor, you don't really worry about this stuff too much. What is the recommendation for net worth before one should consider infinite banking? So I think when you are having a net worth over $1 million, I think it's a no-brainer to use infinite banking concept or whole life overfunded life insurance, where a very small portion of it is life insurance, so you're not paying too much fees and premiums there. But you're using this as a mechanism to front load a lot of cash value into your policy so you can borrow it like kind of like a HELOC does. But this policy goes up with pretty nice interest rate, usually like 4 or 5%, but it goes up tax free. And that's why we like to use it because it's kind of designated in the IRS as something that's grows tax free, and we can use it as a liquidity source and kind of bank from ourselves. I'm not going to get too much into what it is more. There, we have a whole e-course on the topic. You guys can get access to that at simplepassivecashflow.com/banking or simplepassivecashflow.com/bank. But the question is like, recommendation of when it starts to make sense. I would say, maybe if your net worth is under a quarter million, you probably need to put every dollar you have to buying assets or passive income generators such as real estate. And so it's kind of the gray areas anywhere from a quarter million to $1 million net worth. But I would say the first thing to do is just get educated on what it is, and then just start accumulating assets prior to doing an infinite banking policy. Too often do I see, infinite banking is great. I don't get me wrong, right? But I think it's often sold as that product off the shelf, where people just get too a little bit too enamored by the whole concept, and they put it first prior to investing. Remember, the simple passive cash flow trifecta is first going into good deals with people you like, know, like, and trust, and trustworthy, so you can get the passive losses to play different games in your taxes. And that's for a biggest thing for high paid professionals and people with higher net worth. It's more of a tax game and not really about investing per se. Thirdly, in that trifecta, and third, because it's kind of the least important compared to the first two, is infinite banking. So, what is better, investing for cash flow or capital gains? So, cash flow is kind of your monthly or quarterly dividend distributions that you can live off of. Capital gains are kind of more of those big whacks of cash through refinances or sale that come infrequently, maybe every 3 to 7 years. Now, I would say here's kind of a, we always say cash flow is king, you hear that too, but to really make um, a difference in legacy wealth, cash flow isn't going to get you there, right? It's going to be the capital gain that's going to get you, and where you're going to be getting that through value add appreciation. Just think about it, right? Like cash flow, if you put 100 grand in a deal and you're getting, somewhere mid single digits cash flow, every quarter you're looking at maybe $1,000, $2,000 check coming back. And if you ask most accredited investors, they'll tell you that even if they have multiple deals, that they're in, say, in 10 deals, those little quarterly cash flow checks, that's not changing their life. um, you may not think that, then maybe you're not an accredited investor. You're not thinking like an accredited investor, right? What they're in the game for are those big refinances or cash out refinance where, maybe you refinance year three or second year into the deal and you get a huge influx of maybe 30, 50, $60,000 all in big, all in one whack. And then say, you say you got that in year three, 60, $70,000, divide that by three, that's a huge return, right? Much more than that mid-single digit cash flow number, but you add on to for your total return. But as you can see, the cash flow gains are really where you're kind of making those bigger movements. Of course, cash flow is important in my opinion because cash flow is kind of like oxygen. Oxygen is what you breathe, and oxygen is what you need to stay alive, especially in bad times. Right? Cash flowing assets to me are ways to kind of play the game where you kind of win in all situations. If there's bad times, bad economy, you hold on to the asset and you cash flow, you pay your debt service and maybe a little bit more. But the capital gains through value add real estate is really the only way I think you're going to transcend and really climb up the net worth ranks. Next question here. Bob says, any particular reason why syndications minimums have seemingly increased over the past several years? I.e., 50K appeared to be the previous norm, but now I'm seeing 60, 70, 75. Um, well, I got two answers for you. The first is kind of a joke. First is just inflation, man. Like 50 grand ain't worth it what it used to be even a couple of years ago, right? Like, I mean, I don't know when the last time I saw you, Bob, but I think the last time I saw you, 50K is probably worth 65 these days, right? With a few years of 7% inflation. But jokes aside, right? Like, I think maybe this situation, it might be a personal situation where Bob's looking at deals from the set of people he's working with, and these people are getting more reputable and what I call an operator creep, right? If you've kind of noticed what we've done, we have $1 billion of assets under management. right? You look at around and a lot of these other people doing this type of stuff. I mean, I was like looking through my Facebook feed the other day and I was like laughing to myself because here's this guy, he had like $80 million of assets under management. I'm like, are you kidding me? That's nothing, right? We have over 10, 12 times that. And $80 million sounds like a lot, but it really isn't jack. If you want to go into a market, you really want to get economies of scale and respect in the broker community, you really have to have 1,000 units at, at, and that scale. And if you know your 1,000 units times 100 grand per unit, that's like a $10 million or $100 million of assets into one place. Um, and I think that's what you're seeing. The set of people you're working with are climbing in reputation, and they just want to work with higher level investors. I mean, why wouldn't they if they have people who like and trust them? Um, the people who put in the lower minimums are typically the newer investors and typically the more investors that give operators problems, and especially operators who they what they rather do is they rather run the asset and do their job instead of playing investor relations with newer passive investors. But that's probably a good thing that you're seeing those investment minimums go up because that's a sign of that the person you're working with is probably getting more and more. They're picky and choosy in who they want to work with on their passive investor side. Let me see what we got here. We got a few more questions. All right. So I might have to explain this question a little bit. The question is, a lot of deals look like on the surface, basically double my money in 5 years, but if it falls short, we're along the spectrum of vanilla, swirl, chocolate. Would you consider putting in some risk scale to the deal description? So maybe a person put this in can put a nice emoji in here and kind of reword this. I'm not quite understanding the question, but I'll explain the vanilla swirl chocolate analogy. So I kind of posed this analogy because people were like looking at deals and they're like, I don't understand. Like, they all kind of look different. Some look the same. So, the vanilla is kind of what I use as a term for, like kind of more of the boring deal. And sometimes, most times, boring is good, right? You don't want investments that are sexy and like and highly volatile, like crypto investments, altcoins, or venture capital that a good chance you're just going to lose all your money. You want boring deals because boring is what's good, and if you can understand it, it's good. And vanilla deals are kind of like the basic, workforce style housing apartment where it's stabilized, which means it's cash flowing day one, and there's a very mild value add plan. Nothing ambitious. New flooring, new appliances, new paint jobs, some new playground equipment, some better landscaping. Nothing crazy, and nothing crazy in terms of projections with bumping the rents up more than a couple hundred, few $100s a month. Now, that if you can achieve those returns on that kind of risk reward profile, I mean, I'd say do that all day long, and that's what I personally do. I would say 70-80% of my money is in those types of deals. But now, like I was going back to the last couple questions ago, where for most accredited investors, couple $1,000 quarterly distribution check isn't changing their life. Um, it's because, well, they're kind of bored of that, right? It's not changing their quality of life. I mean, of course, it's sustaining them, and added to their whole portfolio. It's great. Nobody's complaining, and it is a bit of a first world problem. But for higher net worth investors who can stomach not having cash flow, it may make sense to go into deals that are more development focused, where you don't have an existing cash flow stream. You're going to have to wait maybe a year, maybe a few years for that. But at the end of the day, the total return when the asset is sold and dumps out the capital to investors, the total equity return could be a lot higher than what you would see on the vanilla side. Maybe in some of these, I call these more chocolate type of deals, these development deals, it's very possible to possibly double your money in 2 years instead of 4 or 5. or maybe triple your money in that time. And there's also deals in the middle, which I kind of call swirl, right? If we're using the whole Costco ice cream analogy, it's a little bit of both. There it's more heavier to middle value add. There's a shorter period of like without cash flow, maybe a year of no cash flow. It's an existing building, so there's an existing profit and loss statement to extrapolate projections, but it's not as high returns as chocolate, but it's somewhere in between, right? And the tricky part that is hard for a lot of investors, well, how do you tailor your personal investment philosophy with what you're trying to achieve? Because you're not going to be able to always hit the same type of B class asset in a B plus location that's $5,000 of value add per unit to achieve $175 in rent bumps across the board. It ain't gonna happen, right? We live in, a lot of these investments are not commodities, and you're gonna have to piece together your portfolio, maybe with a handful of vanilla projects, a few chocolate deals, and some swirl deals, right? And this is what makes things exciting and interesting for a lot of people, and that's where a lot of rich conversation, um, folks, rich conversations that happen, like in our family office group, or when we do select pop-up events for new investors to kind of check out the group and for us to kind of check you out too at the same time. Good questions, folks. Good questions. Hope everybody's enjoying their Friday. Um, Next question here. What have you changed in my mind over the views of the last two years? Anything investment related or otherwise? Um, I still have like calls with all you investors who sign up for the group, and I'll do one investment and one mindset one. First, from the mindset, I talk to a lot of you guys and I see all your financial profiles. There's really nothing that surprises me. I know what your AGIs are, I know what your net worths are. And the one thing I can kind of ascertain very quickly in the conversations I have with you guys as I kind of help pick apart your situation is that a lot of people are in very different mindset spaces in terms of abundance, scarcity spectrum. Right? I've talked to people who are just under $1 million net worth. They're pretty frugal. They save $30,000 to $50,000, and they are living life very happily, from my point of view. And then I see some people who are 2.5, $3.5 million. They're making a high salary, over $400,000 a year, still able to save. They spend a lot of money and they save, yet they still able to save 50, 100, $150,000 a year. Yet they're kind of living as misers and still like in a frantic mode. So I've kind of self-reflected upon myself, and I kind of know where I'm at. And sometimes, and I realize that it's not really about net worth. It's not really what you're saving. At the end of the day, it's more of a mindset. And we all know we control our mindset and our attitude. And you never know when this is all going to end. We're all kind of in a waiting room, ready to go to wherever it is next. But that's that'll I'll just end that there. We'll have some conversations, hopefully when I see you guys in person later on this weekend. But in terms of investments now, so something I've changed my mind on. If you would have asked me like 4 years ago, yeah, let's say 2018, I was not super like thrilled about people using their HELOCs to go out and invest, especially in rental properties, because rental properties can be, especially if you're doing it as a mom and pop investor, you might have to pay $5,000, $10,000 if a tenant screws up your property and moves out. If you guys can go back to the YouTube channel, there's a video of reaction. I think if you search reaction YouTube search for my channel, you'll see one of those awful visions that no landlord likes to see. But what I've realized in these, I hear it from you guys all the time. Like, I think 80% of the investors who I talk to and I do calls with on a daily basis, most of you guys are doing HELOCs to tap debt equity in your rental properties. And if you have more than 20% equity or 25% equity, you got to get it moving. If not, you're going to fall victim to what most investors do, which is they have lazy debt equity in their rental properties, in their assets, not doing anything. And that's just, uh, they're working harder than their money. The whole premise of simple passive cash flow is keep it simple. And that simple thing is to focus on that one thing, which is to have your equity work harder for you, which sounds very esoteric. But what I'm talking about here is to take that dead, lazy equity. Look at your portfolio. For a lot of you guys, it's in maybe your 401ks and these like more conservative, no lower risk, lower return type of funds, or maybe you have $500,000 of lazy debt equity in your rental property or your primary residence that you have to get moving. And you don't have to make 15, 20% on that money. Just get it moving. Put it in infinite banking, making 5, or put it in some pref equity, making 10%. I mean, it's all the average of your whole total portfolio. It's all cash flow that adds up at the end of the day. I so in the last few years, yeah, like the HELOCs, I think it's game on. Like you have to be using that type of stuff to tap in your equity. I don't think that it's irresponsible to be using HELOC, and I think that's where a lot of people who are new to this game, from a mindset perspective, you're using a HELOC, and you're able to get you have to pay debt service on the HELOC, right? Whether it's interest only or monthly payments for like a certain amortization period. But people, they freak out about that because they're still on money Dave Ramsey mindset. That interest rate is kind of accumulating in the back of their head, where they need to have the confidence that their investments are going to pull through at the end, and which they should, right? I mean, it's pretty easy to at least achieve that HELOC rate and then some. Now, it may take some time to get going, which is where I think some people, especially newer investors who don't understand nor have a network around them, don't really trust how this works. But this is what the wealthy do, right? The wealthy are constantly playing arbitrage. Another example is, a lot of the more experienced investors in our group, they'll use a cash value. Um, they'll use their infinite banking to take the loan from their cash value all day, every day. And yeah, you have to pay debt service on that, just like a HELOC. But at that point, this is kind of the next level up. Investors who are already doing that, they don't think twice about that interest payment, that debt service on their cash value line of credit, or maybe some people are doing a secure back line of credit on their stocks that they have. So it's all about the arbitrage game, and they've already have the confidence in what they're investing in, making 10, 15, 20% plus, that it's just an arbitrage or playing the game that the banks play. So I think for a lot of investors out there, the HELOC is kind of a step one, right? That's kind of the feeder into this, and kind of just jump into the pool, you're not going to drown, and then kind of moving off to level 2, which is to tap your infinite banking, and then find other money that's not working for you, and either get a loan on it or sell it and get put into other stuff that's yielding more. Should investors be bothered with rising inflation? I mean, investors are the ones who are going to be benefiting from inflation. The people who are going to be the losers are the people, unfortunately, on the lower end of the economic spectrum, or the people who don't have their money in the game, who are sitting in it in debt, lazy equity in their properties, their primary residence. Yes, I'm talking to you, the person with more than a few $100,000 in your primary residence, such as the grandmas and grandpas out there. Those are the people who are going to be hurt, and essentially it's robbing people. If grandma and grandpa have $1 million to their name, essentially inflation is taking 6% of it every year insidiously. And that's what people need to start to realize. And some people will say that inflation rate is, greatly understated. It's really maybe 10 to 15%. If you go on shadowstatistics.com, you can look at that yourself. But investors are basically hedged or leveraged that inflation is kind of going to help them because inflation is what pushes rents up. And we're thinking about the next short that we're going to make for the GUI group, maybe for the next retreat. And you never want to, as an investment folks, we never would like to guarantee things, but I think I'm pretty confident in saying rents never go down. Last time I checked. Sure, it might go down, on a quarterly basis, but for the most part, if you look at it even on a 12-month run, I don't think there's ever really been a time in history where rents have gone down for a long period of time. Um, that always just seems to be, it's kind of like gravity. Gravity always works. First, somebody says, I believe that real estate investments have a lower risk profile than a stock portfolio, but when you're trying to analyze my total risk of my portfolio, how can I determine the R squared value of each real estate project? Because that is a not number given in a PPM. You're damn right. That's not going to be in a PPM for you. I think real estate investments depends what kind you're going into, right? I mean, let's not all clump them in as one. You can be in a higher risk, higher return. I think that's a higher R squared. I remember learning this in college in my stats class, but I think let me know if I'm using these terminology wrong. But that's where you're going to have the higher variability. Or if I remember those charts where you have like the cone of uncertainty, where if you're in stabilized assets with kind of low to medium value add, I think it's going to be a very low risk that you're even going to lose money ever. That's today never lost money. Um, the joke is just hold on to it long enough for it to go up. And with the inflation, I mean, it's even going to stand a chance of even making more and more money at that point. But I think this is a classic beginner question, and I think what this is like you have to just find other people around you that do this type of stuff, because when you get into the real estate world, it's less about kind of like micromanaging the numbers, because the numbers will happen. The value add will happen, and the properties will increase. I mean, we've bought properties for like 9 million and it goes up to 14, 15, right? I mean, it just kind of goes to show, and that's the power of value add real estate. And that's why, you have to find other people kind of doing this too, because then you start to look and focus more on the people. I think the risks with real estate investments that's hard to quantify is the people. If you work with dishonest people that are competent, then I think you're going to have a much, much harder time growing your money consistently. But if you can mitigate the fact of working with reputable people that have a good track record, that are honest people, that are going to do what they say and take it professionally, then I think you're going to stand a chance to do better than most. And in this real estate world, it's alternative investments. You're off the beaten path, and there's not going to be these type of R square values in performance decks. And you're going to have to build relationships with other people. And this is why we say if you're going to invest more than $250,000 of your money, I mean, you need to be joining the family office group. You guys can apply at simplepassivecashflow.com/journey, but you need to have 5, 10, 20 other people that are doing what you're doing that you can bounce these ideas off of, instead of looking for that R square value in a pitch deck. Here's a question here for investors starting out. How frequently should be jumping into deals? And that's up to you, right? Like I've seen investors invest, well over $1 million in 9 months or less. And part of that is, they joined the network and they built relationships with other pure passive accredited investors. And I I highlight that purely passive accredited investors that are actually investing their own money into this stuff. They got referrals, they figure out who to stay away from, and they went in heavy handed. And now they are happy. Um, with the results. Some investors on the other side of the spectrum, they jump into a few deals at the minimum, and they like what they see and they go in more. But a few deals at the minimum isn't going to get you to go your goals, right? I mean, you need to invest more, and that's the thing with this type of stuff. This stuff isn't magic, right? You're not going to get rich overnight doing this stuff, and nor would you want to, right? Because things that are sort of like crypto that just kind of goes up all of a sudden, easy come easy go, it goes away. And that's why I like to invest in this type of stuff even though it's slow. It's very synonymous with like planting a garden. It takes time, but it's a prudent way of building your net worth. So start investor starting out, depends how much net worth you have, how much capital you have to deploy. This is where we kind of, like, in the intro calls, we kind of look at your situation. And you may have a lot of cash, and that'd be an easy situation to kind of invest that. But most of you guys don't have too much cash. It's mostly locked up in either your home equity in your rental properties, your primary residence, or it's locked up in your 401ks. Hopefully it's not with your current employer. That makes it a little more tricky. But then we start to look at your adjusted gross income. If we start to take money out of your retirement plans, which typically makes sense, and then we can kind of, a lot of this is individual, right? We're not giving any financial advice. It's a very personal situation, but this is what we can get in on an individual consult. But then, at that point, you may have to go out on a limb and take money out of your retirement accounts, which you can't put back. So you're going to need to have a plan and be with high conviction that this is all going to work, and which is, again, comes down to having a network of other people who are actually doing this, because not many people invest in private equity. Most people are kind of suffering and stuck in the mainstream retail market of stock markets, mutual funds. And that's exactly where all the marketing for all these big investment firms want you to stay. Um, it's kind of sad, right? Like we saw not too long ago, Congress was looking to get rid of self-directed IRAs. Um, and you can bet that the people behind that, the lobbyists, are probably those big, large investment firms trying to keep your money locked up in the cafeteria of their garbage options. Just saying, man. I'm just trying to make some conspiracy theories. All right. Well, Clayton has a good question here. What kind of factors or requirement do you look for investing in a syndication deal? Well, I mean, for me, I kind of know already if I'm going to invest before I even kind of look at it personally, because I just kind of know. And it takes maybe about couple hundred deals before you start to develop that for yourself, I think, or investing in maybe a couple dozen deals as a passive investor. But I would say if you're kind of starting out, pick up the syndication e-course. Go to simplepassivecashflow.com/e-course is the way to find that. In there, you have a downloadable spreadsheet where you get the passive investor analyzer, which I built a scorecard, folks, right? Where there's two sections of the scorecard, which is the number section where you can kind of fill out some things. And, there's maybe about, I think, like a few dozen different things you input, and there's different weighting on what's more important. And then there's the people portion where you kind of analyze the people, the operating team, and then there's those other intangibles there. But there's maybe about 40 or 50 attributes that are in that checklist that, just like, if you guys have been with me when we used to, that simple article of how do you vet a property management company, right? On that article. And if you want to go check it out, you can go to simplepassivecashflow.com/PM. I think it was 25 questions you asked a property management company, right? And I keep saying it, don't be a bonehead and ask the property management company all 25 questions. These are just conversations that kind of get it started, the conversation going. And just like a syndication deal, you don't ask people 25 questions, obviously, but and you don't go to the syndication e-course and fill out every single cell on that checklist. And also on that checklist, there's a appendix with, I think, like 50 or 150 questions. I can't even remember, of things to ask. You never ask all those questions. That's silly. You're going to get yourself removed off the investor list That's for sure. Or you're going to find that your investment minimums are going to go up to quarter million for them to just politely or inadvertently, or I guess non-confrontationally tell you to go away. Stop asking them all those questions that are wasting their time, so they can actually go manage the asset. What kind of fact, those are just things to be aware of, I think, and to consider. And I think as a passive investor, you start to realize like the main things, the 80/20 on things that you key in on. And this is where what develops over time of having a network of other pure passive accredited investors. Talk and shop and what do they like? What things resonate with you? And then this is where you start to get to a level where really there's no right in the world, and you're still kind of picking horses here. But if you're kind of to wring my neck and say, all right, Lane, what's the top four things you would consider that I look at? Well, first one, do I know the operator, the person in charge, or am I the guy? That's easy. I trust myself. But do I know the person? And if I don't know the person, does somebody else in my network that I trust, that's not some guy going to get some kind of random referral fee, right? Because that always happens in real estate. But there's somebody else that I trust that I built up through an organic connection that has invested with this person in the past. The next thing I look at is, how much assets, what's their experience, right? Like I said, um, I try and look for something maybe $500 million, $500 million of assets under management or greater. Like I said, we've got over $1 billion of assets under management at this point. The next thing I look at is the deal. What do I like the market? Do I like the geographic location? Is it in right submarket? Because there's many submarkets within a market of say Huntsville, right? Maybe there's a few dozen in the market of Huntsville alone. And then the last one, do I buy the business plan, right? You can see if it's making money today, and do I see the sources and uses, and what is the sources and uses for these upgrades? Is this a legitimate? Do I buy it, right? Like some performers or pitch decks I see, all right, they're gonna put in like everything I said, appliances, paint job, blah 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 blah, but they're gonna bump the rents up 350, $450. And I'm like, no, that's not going to happen. I just know that's not going to happen. And I can already tell that that's a kind of inflated pro forma at that point. And then, of course, I know how to underwrite deals. And I teach this in the syndication e-course. So what are the things to really be on the lookout for, such as like the reversion cap rate? Are they assuming that the cap rate is going to be going up in the future that they're going to be selling at, which means that they're selling it into a worst market? So that's a way of being conservative with their numbers. So if the economy does good and the market gets hotter, then awesome. That's even more gravy for the investors. But I just want to make sure that cushion is built into the underwriting, and other things like rent increases projections, 2 to 3% rent escalators just to account for inflation, things like that. A lot of this is in the e-course again that you guys can purchase. Um, but those are kind of the major things I kind of look for in a syndication deal. I try and keep things very simple because there's a lot of noise, a lot of things to look at, and a lot of things just don't really equate to, if I were to build a fishbone diagram of this type of stuff, a lot of it just doesn't really move the needle on things. Kind of get to the end. I guess we'll go with this last question unless someone's got a really juicy one after this. But Mark says, has becoming a new parent changed the outlook on things, generally speaking? Um, now I realize like why we don't have too many people with young kids, the ages of 0 to 10. Um, Most of our group, 2/3 of the population of our investor club, are folks that are over the age of 42. And these are people who were diligent savers that went to sleep for 10 years. Well, they didn't go to sleep, they just hardly got any sleep, didn't have any bandwidth to focus on investing. And through time, and time is the friend here. Over time, even though they are investing in the normal garbage, 401ks, 529 plans, all that nonsense. Sorry, I don't want to be offensive to anybody in that stuff, but I'm being honest. Um, you know, over time in their 30s and 40s, that money grew to about $1.5 million. So yes, if you're that guy out there who's 45 years old and has a $1.5 million, most of it in your 401k because you did everything they told you to do, yeah, you're kind of Joe Average in our group. We've got another sub minority in our group where we call them Henrys. These are the guys who make about $150,000 plus starting day job. They maybe they're a computer programmer, maybe a young dentist or doctor. And these are the guys who are on the fast track out of the day job. And but not many people kind of in my cohort who today I'm 36 years old, but like from ages 32 to 42 that are kind of the young child ages, very short on time. Um, and to me, it's frustrating because I think those are the people that are kind of grinding it at both ends, what I call the sandwich generation, because a lot of folks in our world, especially from what I hear from our group, we're the ones having to take care of aging parents, young kids. It's just tough life. It always seems like the people who are in our group who are 50 to 60 plus, they're the ones who finally like they're like, yeah, we'll go into that event. We'll see you there in Hawaii. And but I think the perspective that I have is like there's a way to do this very simply and um, high speed, low drag to use that way to invest passively. And at one time, I thought buying rental properties, low turnkey rentals, was the way to go. But then I realized not everybody can do it, and it is a bit of a pain in the ass. Actually, it's a lot of pain in the ass. It's a lot of PETA, and it's high liability. And you're like one or two bad events from some bonehead tenants screwing up your property from giving it all back and then some. And don't get me started on like the burst strategy, which to me is for lower net worth guys who really need to gamble with their money to get it to some substantial net worth. But if you're already $1 million net worth or greater or accredited investor, then there's a way to invest your money responsibly with responsible people, diversify out, and then focus on building a network of other pure passive accredited investors just like yourself, and then focus on the taxes. And then once you've got your taxes done, and then focus on infinite banking, and you're kind of set. The 1, 2, 3 step. But with that, yeah, I'll see you guys on Sunday in San Francisco, and we're going to be doing a lot of different networking. I built the agenda last night. Pretty excited. I think you guys are going to like this. With the amount of people that we have, I think we have 50 people. I know that I got 50 sets of box taco lunches for everybody, but I think you guys are going to be very happy with the agenda that we're going to have to make good use of our time. We're not going to just show up at a bar and make it like a meetup mixer. I think that's a complete waste of time, and that's what people who do on the real estate club circuit and the meetup circuit do. We're going to be doing structure events where everybody gets to meet each other and have table topics and make it very high efficient use of time. And for you family office members coming to the family office event, there's going to be something. It's going to be a lot better to do that though. But yeah, if you guys are new to the group, check out simplepassivecashflow.com/start as the first page, and then check us out on iTunes, Google Play. Share us with your friends, and have a great weekend, everyone. Bye.